Good afternoon and welcome to the Market Closing Show. This is our collab show between Business Today and India Today Television. It's 3 p.m. and we are going to be getting you all the market closing action right here. But first up, let's take a look at what's hot in the corporate as well as the financial space. Markets show cautious trade with the Sensex falling over 200 points and the Nifty testing 25,800 mark. Investors still weigh the mixed global signals while also the real estate and consumer durable sectors face selling pressures. The PSU banks, however, see buying interest. RBI's heavy intervention helps the rupee make its strong recovery in 7 months. In fact, the strongest recovery in the last 7 months, surging 90 paise against the US dollar in the first hour of trade alone. The currency rebounded to 90.09, easing volatility and stabilizing market conditions helped. Silver prices hit a fresh all-time high level on the MCX, crossing the 2.06 lakh rupees per kilogram mark. And on COMEX, it has reached $66.65 per ounce. The weak US jobs data boosted hopes for a rate cut in 2026, while strong industrial demand supported the price surge. Finance Minister Nirmala Sitharaman has warned that tariffs are being weaponized for global trade, making it neither fair nor free. She's also cited that the United States of America duties on India, as well as has stressed the need for careful negotiation and fiscal prudence to protect India's industries. Global tech giant Apple has reached the $2 billion mark in iPhone exports from India in November. Remember, with the total exports now hitting $14 billion in FY26. Meanwhile, reports have also indicated that Apple is exploring talks with Indian chip makers for assembling and packaging iPhone components, boosting Make in India efforts. All right, let's straight away look at how the markets are trading at this point in time. Let me quickly look at how the markets trade is shaping up. On the Nifty, you did see throughout the course of the day, we have been panicking and now we are still hovering around 25,819. We did test that level, but we are off the low point of the day, but still a lot of choppiness that has gone throughout the course of the session. PSU banks, oil and gas, IT, metals and pharma, these are the sectors that are still hovering higher. Among the stocks on the Nifty, you have names like Shriram Finance at top of the charts. You also have State Bank of India from the PSU banking space, 1.5% up. Hindalco, Eicher Motors, Coal India, Sun Pharma. These are the stocks that are hovering higher as far as the Nifty is concerned. On the downside, you have Max Health, Apollo Hospitals, Trent, as well as HDFC Life and SBI Life as those stocks that are still declining in trade. But let's straight away go across to our guest of the day, Sudeep Bandyopadhyay, the Group Chairman of Inditrade Capital, is now joining in to share with us his view on the markets and, of course, give us an understanding of the outlook going forward. Warm welcome to you, Sudeep ji. Good to have you with us. Well, what do you first, make of this extreme cautiousness that's occurring on the markets right now? We first had a lot of resistance above the 26,000 mark, and now we are feeling the pressure on 25,900, 25,800 levels as well. Why do you think the sentiment is absolutely nervous at this stage?
Well, a couple of things are happening. One is sharp rupee depreciation had kind of spooked the foreign investors even further. Apart from the equity investors, even the bond investors had been selling in the last few days. That had led to a massive impact on Indian currency. Of course, RBI did intervene today and some recovery in the rupee happened. But fundamentally, Indian markets are getting hit by FII selling on a continuous basis. And there is no sign of that stopping. Irrespective of whatever positive news flow is coming from domestic markets, I think the FII selling is continuing. And that is leading to this kind of a kind of sell-off and negative sentiment in Indian markets. Domestic news flow, domestic factors are looking all positive, but the relentless selling by FIIs is leading to this situation in the market. As things stand today, there are no fresh positive triggers coming from the global markets. The positive trigger can come if and when there is a trade deal signed with US, or there is Ukraine, Russia, some peace accord is signed. These can be can become positive trigger for FIIs to start becoming risk positive and start putting money into India.
Absolutely. Sudeep then, we are in the last fortnight of the calendar year 2025. It's panned out as a very difficult year for Indian investors. Despite all that pull-out from FPIs and FIIs at large, we have seen that the domestic institutional investors, they continued to pour in money in the Indian equity markets. They did the heavy lifting, either via SIPs, by mutual funds. The average investor has continued to believe in the India story. Going forward into 2026, will they finally see the better returns that they have been waiting for this entire year?
Well, I believe so. Look, what had happened is 1 year back when we started 2025, the valuation was really at stratospheric levels. And, unfortunately, combination of a lot of factors did lead to Indian markets hovering in a range and correcting from there on. And there was very little scope for market to move up when FIIs were continuously selling. Domestic investors did pour a lot of money, but FII selling ensured that market doesn't really keep going up. As far as 26 is concerned, I think time correction has happened quite a bit. Corporate results have improved significantly. Domestic macro factors have improved significantly. In terms of interest rates have come down, inflation is down, demand is picking up. The government has done their bit by providing a lot of incentives to GST rationalization, income tax reliefs, etc. And we are expecting even better numbers from corporates in Q3 and Q4. Now, with this,
Right.
I think a significant, time correction for Indian stock is getting over. Valuations have started looking
Absolutely.
reasonable.
Absolutely. We'll just go across to a breaking news that we're getting at the moment, viewers. Indigo COO has appeared before the parliamentary panel. We are getting to understand that the DGCA, the pilots body officials, are also appearing before the parliamentary panel. Parliamentary panel has summoned Indigo DGCA over the flights mess that occurred in the first 10 days of December. Remember, the Parliamentary Standing Committee on Transport, Tourism and Culture has already begun in the Parliament, and Indigo COO, the DGCA officials and also officials from the Federation of Pilot Association have now been called. Remember, Indigo COO has also reached the Parliament at this point in time, and we are going to be getting to hear as to what really will happen after the presentation there has taken place. Remember, Indigo shares had lost a lot of ground, 17-18% of a fall in just about 8 sessions in Indigo, whereas all this chaos happened. Over 2,000 flights were cancelled by Indigo in the first week of December alone, and all of this was due to the new flight duty norms that had come into effect. Thereafter, we had also seen that the government had stepped in, provided some relief to Indigo by saying that yes, we are postponing the implementation of these rules for you until the new year now, but there was of course needed that Indigo steps up its efforts to sort out all the issues as well. But right now you're given to understand that the stock is hovering about 0.2% higher. Let me go across to Sudeep again to try and understand what exactly should we understand from Indigo and the picture going forward. Of course, this has been probably the toughest period for Indigo in the last 19 years of successful operations in India. Indigo has always been looked at by Indian investors as a company that has had solid fundamentals, repeat profits in a very difficult kind of a sector, which has also seen many other airlines getting grounded for various kind of reasons in the past 10-15 years odd. But Indigo had stayed on its course. It was the first time ever that we saw that Indigo has actually not been able to live up to the expectations. That of course will now lead to a lot of margin pressures for the company, because the company will be giving out a lot of compensations to all the affected passengers, dealing with a lot of penalties now that the management has also appeared before the parliamentary committee, and of course some more details will follow. How would you look at the Indigo company at this point in time as an investor and the opportunity there?
Well, I will stay away. That's one word answer. There are a lot of challenges as things stand today in front of Indigo. Look, the situation arose because of a monopolistic control which Indigo had on Indian civil aviation. An operator with 65% plus market share, I think, is not a very welcome position from a government and public point of view. What's happening in telecom? Look at the government is bending backwards to ensure that the third operator, which is Vodafone Idea, does survive. They don't want a duopolistic situation. And they are going and trying to do everything possible to ensure Vodafone Idea's survival. Look at civil aviation. We have one operator with 65% market share, the other with 27%. I mean, this is definitely a situation which is not a welcome situation. And now with this crisis, getting exposing the problem, I think the government will have to do a lot of things to ensure that the market share of Indigo does come down to a reasonable level so that it doesn't have this kind of a negative effect on civil aviation and the country as a whole. Now, this doesn't augur well for Indigo. Market share loss as well as dominance loss doesn't bode well for a shareholder's point of view and a valuation point of view. The valuation Indigo was getting was because of the dominance, because of the market share. Once they lose that and start losing that, the valuation will never be at similar levels, irrespective of whatever happens. So, to my mind, from an investor point of view, it is absolutely an avoid as far as buying Indigo is concerned.
Clear avoid on Indigo for investors. That's the view that Sudeep ji has shared. And right now, the stock is also slipping away. Remember, it was holding up at 0.2% higher. Now it's down, in fact, still up by about 3.5 rupees odd, but still about 0.07% up, 49.77. It slipped from the day's high level after this news has actually come in. You can see that clear slip in the last couple of moments as we have covered the stock. But let's find out, when it comes to the investment climate, where exactly should you be really looking at? So let's not directly talk about stocks in the stock markets. We will take a few minutes off from the direct stock markets and address a big financial issue staring at the depositors at large across the country. In fact, we have received several queries on this as well. The question, where to invest in times when bank fixed deposit rates are plunging with returns further slashed by inflation and also income tax. Remember, this year already has seen about 4 repo rate cuts by the Reserve Bank of India that has brought down the repo rate to 5.25% from 6.5% seen in January of 2025. While this has definitely brought down the lending rates, so all those borrowers have had a good year because they have started to get competitive rates there, but it has dragged the fixed deposit rates down as well. Remember, they are now down more than 2.5, hitting more than 2.5 crore depositors, where it hurts the most truly. Today, we focus on this, and other than stock markets, gold, real estate, what are the options for those who are actually looking for a safety of a fixed deposit but with higher returns? We're going to be focusing on this with another guest who's going to be joining the panel now. Pooja Bhinde, the certified financial planner at PB Investments, is now with us. Pooja, warm welcome. Good afternoon to you. Good to have you with us. And of course, Sudeep ji is with us constantly. We will first try and understand from you. After 4 cuts of the RBI, we have been consistently seeing that the banks have been reducing their fixed deposit rates, and now they are hovering at record low levels or near record low levels. The 1-year, 2-year returns on your screens will come in are anywhere between 6.2% to 6.7%. The lower you go in terms of tenure, you will find these returns even lesser as well. So the big question is, are the good days of investing in fixed deposits, where the maximum chunk of investors in the country really put their money, is it behind us?
Thank you so much, Sakshi, first of all. As you rightly mentioned in the beginning that, because of the rate cut, there is a good news for the loan buyers, loan borrowers. But at the same time, when you look at investors, I think transition is very important when it comes to, fixed instruments, wherein, the investors are still, I don't know, somehow hooked on to the, fixed deposits, the bank fixed deposits for that matter, I would say, wherein we all know, the word that it says that it's fixed and it's as safe, it's not really safe. We all know that, there's a, insurance of approximately around 5 lakh rupees to any FD attached. So the retail investor should understand the risk, and at the same time should understand and should evaluate what other options, like as we are speaking right now, the interest rates have fallen down. So I think one thing they should first, come to a conclusion, or, make a financial plan wherein, why are you investing in an FD, or why have you
Sure.
chosen a product like FD? So first of all, it comes to like there is some capital protection mindset to it. And
Yes.
secondly, there is a tenure that is in mind. Say, for
Absolutely.
example, the tenure is for 1 to 3 years, and capital protection is something which is very important, but not return year. Because as we, talk about returns, we have other options wherein you get better returns than FD, but at the same time, there is risk and there is tenure which needs to be, given to those instruments. So I would
Absolutely.
say, debt mutual funds as a category is a very attractive category when it comes to, fixed income, I would say. I
Okay.
know the taxation and, that has been at par now with the, fixed
Fixed
deposits. But
deposits. Okay.
when you say debt mutual funds, there is no lock-in, there is liquidity all the time. Secondly, the taxation that occurs, it's deferred. When you actually sell that, debt mutual fund, at that point, the tax is levied to you. And thirdly,
Yeah.
there is also a little bit of capital appreciation there. And especially when we are talking about this right now, Sakshi, because the interest rates have fallen, the debt
Yes.
market is actually very attractive right now because
Very
it's
attractive
investment
right now.
proportional to the bond, right? To the bond
So,
prices. So the
abs-
NAVs are also shooting up. So I would say somebody who is looking at a time horizon of, maybe 2 to 3 years can look at options like a short term or a medium term debt fund, a corporate debt fund, or also there is one more wonderful category which is income plus arbitrage.
can you
This
also just side by side tell, Pooja, for all our viewers who are listening to you, as an alternative to FD, what are the kind of returns these, avenues provide to them on an average 2 to 3 year time horizon, like you're advising them to?
Yeah. So first of all, in terms of return, obviously there is no fixed return that we say as in an
Sure.
FD, but the return here we see is more in terms of the post-tax returns, I would say. So for example, if there are two products giving 7% return, and if you're in a high tax bracket, specifically when I'm talking about a high tax bracket,
Yes.
investor. So after 30%, the 7%, the post-tax percent comes to approximately 4.9. And if you
Hmm.
opt for an income plus arbitrage kind of a category, wherein if you can wait for 2 years, then your taxation comes to 12.5%. So
Okay.
there around 6%. So obviously there is 1.25% of alpha there. But at the same time, you need to understand, because what is your duration to that particular
Yes.
product, that is very much important. As I mentioned, income plus arbitrage, because it's a fund of
That's a
fund.
good idea for at
Yes.
least the higher tax bracket people, right? Sudeep, let me get you into that conversation as well. Do you also believe with the falling FD rates, a large chunk of our investors in India, should they gradually shift for better avenues? And what would you advise them in case they're looking for the safety of a fixed deposit and yet are risk averse and may not want to invest in stock markets as yet?
Well, I think you never get safety of fixed deposit anywhere else. While debt fund investing is good, but interest rate moving up and down can kind of shake the balance. And if you are investing for a short duration in a debt fund, that can be give you unfortunately negative returns as well. So it's always better to be a little careful. But having said that, the opportunities are many, and instead of investing in a fixed deposit, I've been recommending investors to invest in balanced funds. Now, balanced funds invest in debt as well as equity. It's a balance between debt and equity, and they have over the last many years performed commendably well. So
Okay.
that is one category which I recommend. The other category which I've been recommending investors is multi-asset allocation fund. Now, these funds invest in debt, equity, as well as commodities. Now, while I
Okay.
talk commodities, it is actually gold and silver.
Gold and silver.
So,
Hmm.
so you can understand in today's day and age where gold and silver is running away, these funds have been
Absolutely.
performing exceedingly well. So, I think both these categories of funds, multi-asset allocation fund as well as balanced funds, needs to be looked at from an investor's point of view. Of course,
Okay.
nothing is zero risk like FD, but
Yes.
this is worthwhile taking this risk.
Okay, Pooja, let me ask you to help us understand, where does the small saving really fit in into this cycle? There are PPF, there is the National Savings Certificate, there is Senior Citizen Scheme, Sukanya Scheme. So many of the small saving schemes that the government is running as well. So how would you compare that with an FD vis-a-vis returns and vis-a-vis the flexibility and taxation part?
Right. So, Sakshi, because as you mentioned, when we are talking about a non-equity product and when we're talking about debt, at large, obviously small saving scheme also, is one of the category. But as you mentioned, the instruments like a PPF, which has a time horizon of 15 year, a long tenure. Okay, so people look at it as a retirement product, or as a long
Correct.
term investment product, which I would say, apart from your equity investments, which we also hold for long term, I think PPF also should form a part of your portfolio. There should be some asset allocation in any individual's portfolio, so that role can be played by PPF. And the other
Okay.
instruments like senior citizen, depends on if you're a senior citizen, but again, there the interest is taxable, but there is a lock-in of 5 years. National saving certificate again. So I would say the interest nowhere is tax exempt apart from PPF, but PPF has a longer time duration. So understanding the needs is very much important. Secondly, as we spoke about debt funds, I understand that returns are not made here, but at the same time, your capital protection and the taxation, the post-tax returns are very much important. And thirdly, if you want to make a little more return, or generate more
Sure.
alpha, and if you have a time horizon which can go up to 3 to 5 years, then I would say the category which Sudeep clearly mentioned, like a hybrid category or a multi-asset, can work.
Sure.
Wherein equity savings fund can, actually play a good role here, because the equity is, in the range of 10 to 15%. So your risk is only that much, but at the same time, your post-tax returns are good. Yeah.
Okay, thanks a lot, Pooja, for sparing your time for us and for advising all our viewers on the debt side as well. We also have one more query coming in. Sudeepji, I'm going to be taking that query with you. Praveen Sharma from Delhi says, I'm 65 years old and I'm a pensioner with all my investments in actually fixed deposits. Now with the FD rates falling, what should I do with my investments? Where should I invest? Now here is a, kind of a situation where we have a person who's 65 years old, probably retired, and, like he said, he's a pensioner. So where should he be now investing in a falling interest rate scenario? We're also contemplating, Sudeepji, that there could be one more rate cut probably going forward, so which could actually lead to fixed deposit rates probably at record low levels.
I completely agree with you, but the kind of profile which you are talking, I think unfortunately, recommending any kind of equity-related investment is not fair. But having said so, option remains only fixed deposits. So instead of having fixed deposit in a bank, I can only recommend that he can buy fixed deposit with some of the leading private companies. So Mahindra Finance comes out with fixed deposits. Bajaj Finance comes out with fixed deposit. These are credible brands. And remember, the fixed deposit rates for these companies are much better than the typical bank FD rate. So my suggestion will be stick to FD for a pensioner with 65-year age. Stick to FD, but try credible private sector FDs, which will give you better returns. If you can take little risk, again, I would mention this clearly, if you can take little risk, put a part of this money in a multi-asset allocation fund, and I think that will give you fantastic results.
Okay, so here Praveen ji, although you are 65 and a pensioner, fixed deposits you can continue, but with a private player. If not, you can go for a multi-asset allocation strategy, and in a fund like that, you could probably earn better returns as well. Let's now look at the markets closing. A minute to go before we shut shop for the day, and we'll come back to more questions with Sudeep ji as well. So, when we look at the Nifty, it's back above the 25,830 odd mark, so slightly off the low point of the day. That gives us some kind of a confidence that maybe tomorrow, even though we open up with the Sensex contracts expiry tomorrow, there could be some attempt to come back. The Nifty Bank also has inched higher from the day's lowest point after the entire day's choppiness that we have seen. 58,951 in front of you. That's a 1/10% lower in trade, but definitely off the low. Look at the IT stocks that have led to some gains. 2/10% higher for the index as a whole, even though we are off the low point of the day. PSU banks, however, outperformed today. Over 1% kind of gains in this extremely weak and volatile market. You can see the PSU banking index that was up in trade almost by 1.2%, ending the day also with stable returns. Right from the morning trade, it had been holding on to. Oil and gas metals from the commodity basket also managed to pull up some returns. Like I pointed out initially, the top winners on the Nifty in today's trading session are Shriram Finance, almost 2% of a gain that actually can be seen there. You also have SBI, State Bank of India, and Hindalco as among those other gainers that formed a part of the top three. You also had Eicher Motors, Wipro and Coal India as among those gainers. But on the flip side, on the lower end, you had the real estate stocks, you had the healthcare stocks, mid and small caps also that declined. Trent, Apollo Hospitals, Hero Moto, these were the stocks that in fact declined anywhere between 1.5 to 2.5% percent in trade. HDFC and SBI Life from the insurance basket also declined. Coming back to Sudeep ji with all those questions that all of you viewers have sent us. Let's take the next question. This one is from Pratik. He's from Agra and he's actually asked you a stock market related question itself. Pratik says that I want to invest in defense and shipping sectors. Could you suggest any top stocks from within this basket that I can invest in for the long term, Sudeep ji?
Well, if you want to invest in defense at current market, I would recommend you buy either Larsen and Toubro or Bharat Forge. Remember, these also have a very advanced defense businesses, both of them. Bharat Forge is growing its defense business. Larsen has already a strong defense business. The valuation wise, I won't recommend the public sector defense companies at this stage, but buy into Larsen at this stage or Bharat Forge at this stage. You will get the benefit of defense as well.
Okay. Next one is from Pooja from Mumbai. She says, which stocks should I be buying to capitalize on the surge in the silver prices out there? I don't have a doubt, Sudeep ji, as to which stock will you be marking there, but definitely please go ahead and help our viewer out there. Silver prices by way of proxy investment in markets, what would you advise?
The only stock available which produces silver is Hindustan Zinc. So if you have to really buy Hindustan Zinc. I don't think I will recommend Hindustan Zinc. I will recommend rather you buy the holding company Vedanta because it has got multiple other levers apart from silver. The aluminum prices are at record high levels as well. And we believe that next 2 years, globally, aluminum prices will be at elevated levels. Vedanta derives roughly 50% of its profit from aluminum, and this does augur very well. Of course, the benefit of Hindustan Zinc, silver, will also go to Vedanta, being a holding company. There is a demerger of businesses happening in Vedanta, which will lead to value unlocking. So, the smart way to play this will be through Vedanta. So, buy Vedanta.
Okay. Let's take the last question now. This one is from Pragya from Delhi. She says, given the ongoing tariff-related uncertainties, is it safe to invest in the IT stocks for long term? What would you advise there, Sudeep ji?
Obviously, IT can be good, but it's very difficult to predict the situation as far as large cap IT is concerned. But some of the mid cap IT, we are positive. So if you are really interested in buying IT from long term, do buy Coforge, do buy RateGain Technologies because they are companies who cater to travel and tourism segment amongst others. Now, globally travel and tourism is booming and the business of companies, IT companies serving travel and tourism is also booming. So buy RateGain Technologies or Coforge for long term.
Okay, there you have it. You've actually got to know which are the kind of stocks that you should be looking at. Sudeep ji, many thanks for being with us as always, for guiding all our viewers of India Today and Business Today television as well as to what should be their strategy. With that, viewers, it's a wrap on the Business Today show. And in case you too have any questions about your investments in mutual funds, SIPs or gold or stock related questions, send them to us on the number that's flashing on your screens. We will be happy to take up all your questions with our top market experts. And don't forget to catch the market opening action tomorrow morning at 9 a.m. with Abha Bagaya.